This is Wallet Brief, where we cut through the noise and focus on what matters to your money. Stock market today, searches remain elevated, but there's a catch. U.S. stock markets are closed today, February 16th, 2026, in honor of Washington's birthday, commonly known as President's Day. Trading will resume on Tuesday, February 17th at 9:30 a.m. Eastern Standard Time. But even with markets dark, the story from Friday night's data continues to shape what happens when the opening bell rings tomorrow. Stocks gained and bonds steadied after benign U.S. inflation data reinforced expectations that the Federal Reserve will cut interest rates this year. Headline U.S. CPI sits at 2.4, with core CPI at 2.5, which means the cost of living is still rising, but now closer to the Federal Reserve's comfort zone. That's the lowest core inflation reading since March 2021. Futures on the S&P 500 added 0.4 and Europe's Stoxx 600 index rose 0.4 overnight, with trading volumes thin with the U.S. and China shut for public holidays. The U.S. 10-year Treasury yield is around 4.07, continuing its decline to levels not seen since December. The market is betting that softer inflation gives the Fed room to cut rates, possibly as soon as this summer. Here's what's actually happening. Inflation is cooling just enough to shift the conversation from, will the Fed cut rates, to when and how much. Last week's jobs data showed resilience. 130,000 jobs added and unemployment dropping to 4.3, but annual benchmark revisions revealed that 2025 job growth totaled merely 181,000, representing the weakest performance since 2003, excluding the COVID pandemic and 2008 financial crisis periods. That combination, moderate job growth and falling inflation, is creating a window for the Fed to act without reigniting price pressures. Meanwhile, the main stock market index of United States, the U.S. 500, rose to 6,851 points on February 16th in futures trading. The three-day weekend gives investors time to digest last week's rotation out of megacap tech and into defensive sectors, which outperformed despite the headline index decline. Lower inflation means lower borrowing costs are coming, eventually. If the Fed cuts rates later this year, you'll see relief on mortgages, auto loans, and credit card interest. That 4.07 Treasury yield is already translating into slightly better mortgage rates for new buyers. For savers, though, high-yield savings accounts and CDs may start paying less as rates fall. If you locked in a 5 CD last year, you're ahead of the game. For investors, this inflation news is a mixed bag. Tech stocks that got hammered last week may stabilize if rate cut expectations build, but the rotation into utilities, healthcare, and consumer staples suggests the market still favors safety. Your 401k performance this week will depend heavily on which sectors you're weighted toward. When markets reopen Tuesday, watch the earnings calendar closely. Walmart reports this week, and their results will show whether everyday consumers are feeling inflation relief at the checkout line. Deere reports Friday. Farm equipment sales reveal a lot about rural economic health and ag commodity trends. Also keep an eye on any Fed official commentary about the inflation data. If they sound dovish, rate cut expectations will firm up and markets could rally. Finally, watch whether last week's rotation holds. If utilities and healthcare continue leading while tech lags, that tells you the market is still defensive. This pause gives everyone time to reset. That's it for today's Wallet Brief. Subscribe for daily updates on what's moving markets and your money.